a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi, everyone. Welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about big tech stocks and ETFs, and these stocks are leading the market again. We know that stocks recovered and they rebounded from earlier tariff driven shock. And May was, in fact, a great month for for stocks, and the Nasdaq 100, the Nasdaq jumped 10% in May. Information technology and communication services were the best performing sectors. For the Nasdaq, it was the best monthly gain since November 2023. And that was mainly because big tech stocks reported better than expected results and trade tensions also eased. Then chip makers like AMD, like Nvidia and AMD, got an extra boost from deals that were announced in the Middle East. We know that several AI infrastructure projects were unveiled during President Trump's visit to the region. And from earnings, we learned that the AI trade remains intact. Additionally, investors also believe that because of healthy balance sheets, low leverage, and strong cash balances, these megatech companies, tech giants, they are more resilient to economic headwinds. If the economy slows down or falls into a recession, these companies could continue to do well. Now, let's talk about the performance of the group, and there's a lot of divergence in the performance. This chart shows the year to date performance of the Max 7 stocks, and we'll notice that Meta is the best performer with a gain of about 14%. Then Microsoft is up 10%. Nvidia and the Nasdaq 100, they are up about 2.5%. And then you have the laggards. Amazon is down about 6%, Google about 11%, Tesla about 15%. Apple is the worst with a loss of about 19% year to date. Now, the picture changes a lot if we look at the performance since April 8th bottom. And since then, Tesla has emerged as the best performer. And that is mainly because investors cheered that CEO Elon Musk will be leaving Doge and will be returning to Tesla, and he'll be devoting more time to Tesla. So since April 8th bottom, Tesla has rebounded about 55%. Nvidia has also done very well, 42%. And then Microsoft and Meta, they are both up about 32% each. And let's look at the results then. So according to Zacks calculations, Zacks earnings trends, Q1 earnings for the Magnificent Seven group of these stocks, they are up about 27.2% on 12.2% higher revenues. And for the technology sector as a whole, earnings are expected to grow about 24.4% on 11.2% higher revenues. So obviously, solid results. Their core businesses are performing very well, and the AI momentum continues. That's what we learned from the results. Obviously, the most anticipated event of the month was Nvidia's earnings, which are closely watched by the market for signals on the state of the AI revolution. And company reported very strong results, beating both on the top and bottom lines, of course, showing that the AI trade remains strong despite China restrictions. And if these China issues are resolved, then obviously NVIDIA will continue to do even better. And we saw that several other growth areas are there for the company: sovereign AI, and then the autonomous car, humanoid robots, it's etc. In addition to generative AI. Apart from NVIDIA's results, we learned from other results, the results of Microsoft, Meta, Alphabet, and Amazon. They together comprise more than 40% of NVIDIA's revenue. And we learned that they continue to invest heavily in AI infrastructure, which is obviously great for NVIDIA. Now, among the results, we saw that Microsoft investors loved Microsoft and Meta results in particular. Microsoft reported very strong growth in Azure cloud computing division, with AI services adding a notable boost. And Meta also reported very strong sales, and it projected steady growth and eased worries about the impact of tariffs on its digital ads business. Now, we should add that these two companies, Microsoft and Meta, they are among the early adopters, and they are also showing that they are able to monetize AI. Microsoft has been integrating AI into its existing products and services, and it's showing some results, particularly in its Azure Cloud platform and Copilot suite. And Meta has been indicating that AI plays a crucial role in enhancing its advertising capabilities. Apple and Amazon investors did not like the results so much, and we know that these two companies are most exposed to tariffs and trade wars. And for Apple, we know that Apple has kind of fallen behind in the AI race. So that is another reason why the stock has not done well this year. Tesla reported less lackluster earnings with slowing growth, but Tesla's stock has been trading not on fundamentals, but on headlines related to Elon Musk's return to Tesla. Now, let's take a look at some of the ETFs that you could use if you want to. Your exposure to big tech stocks, if you sold earlier this year when these ETFs were hit, these stocks were hit, and if you want to add back exposure to the big tech stocks, then you could take a look at these ETFs. So the ETF that I like the most for getting exposure to all big tech stocks is the Invesco Nasdaq 100 ETF QQQM, which is the cheaper version of the ultra popular QQQ ETF. And QQQM has itself become quite popular with 48 billion in assets. If you want to learn more about this ETF, you can go to the quote page on Zacks.com. You can read our research report articles, and this has an expense ratio of 15 basis points. You can use the link to go to Invesco webpage for the ETF, and you will see that it holds all those stocks. It is top heavy with all those stocks in the top holdings in market capitalization weights. Then another ETF that is very popular and ultra cheap, it charges just 7 basis points. So it is the Vanguard Mega Cap Growth ETF with the ticker symbol GK. It has an expense ratio of just 7 basis points, as I mentioned. And if you look at the holdings, here's the portfolio. So again, you will get a lot of exposure to these mega cap tech stocks: Apple, Microsoft, NVIDIA, the top holdings. Then iShares launched an ETF a few months back. So that provides an even more concentrated exposure to the mega cap tech stocks. It is the iShares Nasdaq Top 30 ETF, QTOP, and as the name suggests, top 30 stocks. So if you look at the holdings, Microsoft, NVIDIA, Apple, Amazon, these are the top holdings, and you will see even greater weights because this focuses just on those top 30 stocks. It has an expense ratio of 20 basis points. Now, Then you can also look at the Max 7 ETF. Max, so this equally weights all the Max 7 stocks. So if you look at the holdings, you will find that these top holdings, Tesla currently has a higher weight because it has outperformed lately. But at the time of rebalancing, all these seven are brought back to equal weights. Now, if you want to get exposure to other stocks within the S&P 500 and avoid these Max 7 stocks, many investors, they do not want Max 7 exposure, then you can look at the XMAG ETF by Defiance, which has exposure to all other holdings except the Max 7. So you will get exposure to stocks like Broadcom, JP Morgan Chase, Berkshire Hathaway, etc., and not to the Max 7. And on the next slide, I have the comparative performance of these ETFs versus the S&P 500 index. So obviously, because these Max 7 ETFs were down earlier in the year, so that is why the Defiance ETF is up about 4%. Other ETFs are up between 1 and 2%, pretty much similar return. But the Roundhill Max ETF, that is down about 3%, and that's mainly weighed down by Tesla. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer. Make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.